Today's video is about the 2008 through 2010 real estate crash, as we've called it. It's also known as the Great Financial Crisis or the Great Recession. It's all the same, talking about the same time period from about 2008 up through about 2010, 12. It's set to end at different times. The stock market actually recovered in about the middle of 2009 and just went up ever since. But housing did not recover that quickly. But we're going to cover that time period and also the time period that led up to that and the events that led up to it. So housing started collapsing in about late 2007, and then we call it a crash, but housing does not move fast. It doesn't move nearly as fast as the stock market. Housing prices move very slow. So it actually took about 18 months for housing to go from the top in about late 2007, and then it finally bottomed out in about the middle of 2009. So you can see we might call that a crash, but it took a long time to happen, just month over month of lower and lower home prices and people trying to sell out homes and get out of homes, tons of foreclosures on the market, and that actually continued for multiple years. You could still find really good deals on real estate up through 2011 and 2012, but it took a long time. So housing moves slow. There's time to get out of the way, and if you have something that you want to sell, there's usually time to sell it. You can lower the price and get rid of it, unlike in the stock market where things happen in seconds. But we have to go back to talk about that time period. We need to go back and talk about the time period leading up to it. So the late 90s up through the mid and early 2000s. So there was some push out of the U.S. The federal government to make loan products, or to have the banks and Fannie and Freddie, the GSEs, make loan products that would help previously borrowers that didn't qualify for traditional loans make loans available to them. They were typically, I think today we mostly call them what was called subprime borrowers. And what it was borrowers, say you had a job that was mostly cash, where most of your income was cash, and maybe you didn't report a lot of that. Maybe you were a barber or a hairdresser, or you worked for tips. There's other people that would fall into that category too, that would have been considered subprime borrowers. But maybe you had income, but it was hard to document your income. So the government decided that they wanted these people to be able to afford homes too. They were probably making a good income, they just couldn't document it. So that's one of the contributing factors. And they did come up with these loan products. They were often called no-doc loans. So that's where you would come into a bank and you would be applying for a mortgage for a house, but you didn't have to prove your income. You didn't have to provide any documentation. It was just based off of credit score and the value of the house, things like that. But then you didn't maybe necessarily have the income that you stated on the documentation. So it made those borrowers a good bit riskier. There was also adjustable rate mortgages that they're still available today, but they were very common back at that time. But that's where the interest rate can fluctuate on the loan itself, and it moves with the Federal Reserve prime rate. So you could be paying. A lot of times these loans will come with a teaser loan, a teaser interest rate. And at the beginning of the loan, it may be a really low interest rate, maybe even lower than an ARM would normally be, an adjustable rate mortgage would normally be, to help people get into it. But that rate is going to reset at some point. And it would just be according to the type of loan program that it had. It may be maybe a year later, it may be 3 years later, it may be 5 years later, but that rate is going to usually reset. And it's typically going to reset higher. So that's not necessarily a good thing for the borrower. Yes, you may be able to get into that house today, but what happens when that rate resets, 1, 3, 5 years later? And that was a contributing factor to the great financial crisis, because in about 2007, interest rates had been low leading up to about 2007. And the Fed started raising interest rates in 2007, and a lot of the borrowers who had gotten rates in the late 90s and early 2000s, or had got mortgages during that time with adjustable rate mortgage or adjustable rates on them, in 2007 they started not being able to afford their homes and started walking away from them, just realizing it wasn't worth it. They were also seeing, so not only was their payment going up because the interest rate on that mortgage was going up, but also what they also saw was the value on their house was going down. And so the contributing of those two things made it so that they didn't want to stay in the house. They made the decision that it was better to walk away, let the house get foreclosed on, let the bank take it back, and just go and rent. One of the things that you can look back to this time period, to the time period during the housing crash, the great financial crisis, and housing prices went down, but rents actually went up during that time period because people were walking away from homes that they owned and were making payments on, making the rational decision that, hey, I'm not going to make a payment that has went up, 50 to 100%, which happened in some cases. Your payment could easily increase by 50%. And that happened, and people would make the rational decision to walk away from making a mortgage payment that had gotten too high and go become a renter because the payment had went up, the value of the house had came down, and they just couldn't see making the payment on that anymore. And it was a rational decision. Millions of Americans made that decision to walk away. I did some math on what someone could have seen from a small interest rate movement. Now, this won't include taxes and insurance. So say if they got an interest rate on a $200,000 loan at 2% on a 30-year mortgage, that payment would basically be $740. It's just principal and interest. That's not taxes and insurance. Okay, that same $200,000 loan, if it reset to 6%, which could happen. I mean, we're seeing rates at 6.5 today for a 30-year mortgage. Their payment on a 30-year mortgage would go to basically $1,200, $1,199. So that's a $460 increase from 2% to 6%. So a 4% change in interest rates, which increases their payment 62%. I mean, that would be nuts. I don't know how many of us could afford a 62% increase in our mortgage payment, but this happened with adjustable rate mortgages back at that time. At that time, 50%, it's about 50% were of the U.S. mortgages were adjustable rate. Today, it's not nearly as high. It's under 10. I think it's about 5% today are adjustable rates. Banks just don't offer them as much. And for good reason. They can be dangerous. I have never had an adjustable rate mortgage, and I don't know that I would ever have one. I won't say that I wouldn't. It'd have to be a very special situation, but I like to know what my payment is going to be 5 years from now, 10 years from now, and 20 years from now. And I know what that is because it's at a fixed rate. It's not going to change. The principal and interest portion of my mortgage is not, or any of my mortgages are not going to change. It's fixed. There was also a general belief that real estate always goes up, leading up to the crisis. And that's just not true. I think that came from just a long run of real estate increasing in prices over the previous decades. Pretty much since the 70s, we had seen consistent growth in housing appreciation. And I think a lot of people thought that. So there were people, I've told the story before, of a guy that he could make 5 mortgage payments. So he had bought 5 houses and was carrying the mortgage on all those houses. And he lost them all during the great financial crisis because none of them were cash flowing. None of them were putting money in his pocket. All of them were taking money out of his pocket. And then he saw the value of them go down. The value dropped. And he made the rational decision like, hey, this isn't, the value on these is not as high as it was. I'm going to let all these get foreclosed on. I'm going to stop making the payment on them. But if he had been cash flow positive on those, if each of those had just been putting $100 into his pocket every month, he could have held on to them. He could have kept all of them. He could have rode out the storm of the housing crash and then sold them at some point on the other side, but that just wasn't true. That's the reason that cash flow is so important for rental real estate, because you can hold that asset forever as long as it is putting money into your pocket. I'm going to end the story there today. I'm going to pick it back up tomorrow and also add some more context and details and things like that of other things that also happened that were contributing factors to the great housing crash. I'm going to leave you with a quote. This quote goes with the movie The Big Short, which is also about that time period. That's actually my favorite movie because it covers the time period leading a little bit up to the housing crash, and then it covers through the housing and stock market crash. And it gives a lot of details that people didn't know about things that were happening within the banking system at that time period that made it a lot worse. And we'll talk about some of that tomorrow. I'll cover that. So this quote comes from Mark Twain, and it's I think it goes good with the people thinking real estate always goes up, which it does not. And that is, it ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. So it's not what you don't know that gets you in trouble. It's what you know for sure that just isn't true. So that comes from Mark Twain, and I think that definitely describes what people were thinking leading up to the housing crash. My name is Mike Williamson. I live in Cincinnati, Northern Kentucky area. I'm active in real estate here. I'm actually a private money lender here on fix and flips, and actually flip in a few other, or not flip, but actually lend on fix and flips in a few other places too. If you want to reach out to me, there'll be Calendly links available for you to book a 25-minute call with me, and I hope y'all have a good day. See ya.